The 30-year fixed mortgage rate dropped to 6.47% on June 18th, 5 basis points below the prior week's 6.52% per Freddie Mac's weekly survey as reported by the Federal Reserve. That is a modest move in isolation, but it extends a sustained drift lower in long-term borrowing costs that has direct consequences for every buyer, builder, and lender with exposure to the U.S. housing market. For perspective, the 30-year rate spent most of the decade between 2012 and 2021 in a range of roughly 3 to 5%, the conditions that underpinned a prolonged run of housing appreciation. The post-pandemic Federal Reserve hiking cycle pushed the rate past 7% by late 2023. Since then, it has tracked lower alongside the federal funds rate, which sat at 3.64% as of April 2026. The current level represents meaningful progress off that peak, but the rate environment remains a significant affordability headwind for first-time buyers and rate-sensitive households. The mechanical link is straightforward. The 30-year mortgage rate is priced off the 10-year U.S. Treasury yield, with a spread that accounts for prepayment risk and credit quality. As of June 16th, the 10-year yield stood at 4.43%. The resulting spread between that benchmark and the current mortgage rate is 204 basis points. Within historical norms, though wider than the compressed conditions of 2020 and 2021. When the 10-year yield comes down, as it has been doing, the mortgage rate follows, typically with a short lag. The driver of that Treasury move is market pricing of future Fed policy. What is driving the Treasury move? The short answer is that the macro data gives the Federal Reserve room to ease. The Consumer Price Index stood at an index level of 332.4 in April 2026, reflecting inflation that has moderated significantly from the post-pandemic spike. The unemployment rate was 4.3% that same month, softening but not in freefall. Together, those readings support a Fed that holds or cuts rates, not one that hikes. Bond markets appear to have already made that call, and the 10-year yield is reflecting it. On the equity side, the clearest sector beneficiaries are publicly traded homebuilders. D.R. Horton, Lennar, Polt Group, and Toll Brothers all operate in a demand environment directly tied to monthly payment affordability. Lower rates expand the pool of qualified buyers, reduce cancellation rates on signed contracts, and cut the cost of rate buy-down incentives. Subsidies builders fund to lower buyers' effective rates, which come directly out of gross margin. All of those cost pressures ease as market rates fall. These names represent the primary publicly traded concentration of new home construction demand in the United States. The effect extends into real estate finance. Mortgage real estate investment trusts, including AGNC Investment and Annaly Capital Management, hold portfolios of agency mortgage-backed securities whose economics are sensitive to the pace and direction of rate moves. A slow, measured decline in mortgage rates is more favorable for these firms than a sharp drop. It supports spread income without triggering the mass prepayments that force reinvestment at lower yields. Regional banks with significant mortgage origination franchises also see pipeline economics improve as origination volume recovers. The rate environment is beginning to make mortgage lending a more attractive business again. The most immediate consumer-level effect is on refinancing. Homeowners who locked in 30-year mortgages at the 2023 peak, when rates were above 7%, are now approaching a rate differential large enough to make refinancing economically rational once transaction costs are weighed against lifetime interest savings. As that cohort acts, mortgage originators, title insurers, and servicers all see volumes recover. This is a slow build dynamic rather than an overnight surge, but it compounds. Each incremental decline in the 30-year rate brings another cohort of existing borrowers within range. 3 data releases will determine whether this downtrend continues. First, the next Consumer Price Index print. If inflation holds near current levels, the Fed's easing posture remains intact. Second, the June jobs report. Continued softening in labor markets reinforces the rate cut case. A rebound would force a reset. Third, the Federal Open Market Committee's next rate decision and forward guidance. With the effective federal funds rate at 3.64% as of April 2026, the question is how many additional cuts, if any, are on the horizon. Those three releases will move the 10-year yield, and the mortgage rate will follow.